Hello traders, Gary Wagner for Trending Markets. Just about 11 o'clock in Honolulu, 4 o'clock in New York on Wednesday, February the 10th, 2016. We usually start by looking at the Dow Jones Industrial. I typically will film the gold forecast first, trending market second, because by the time I get to it, it's about 11 o'clock and we've seen the S&Ps close, Dow Jones Industrials close. But we're going to start with this because as we finished the gold forecast, we continue to see this market rage and in fact trade to new highs. In fact, I just saw a 96 print on the market. And what that means is that although we had the Dow Jones Industrial Average trading higher for the better part of the day, as we go into the close, we've got about 5 minutes left in trading. You can see we have definitively now broken back below 16,000 in the Dow Jones Average. We're trading over a 0.5% lower on the day. And when you consider the high was 16,201, we are literally 300 points off of the high. That, of course, coming on the heels of a testimony made by Janet Yellen in which she said that the recovery was disappointing and that she is still looking at two major factors, that is inflation and employment figures to guide them. She also brought up the word negative interest rate, and she used some language which was perplexing to say the least, but the fact that she put that verbiage into a testimony tells me that negative interest rates is definitely something the Fed is considering. Now, of course, gold is going to react to the fact that interest rates are not rising as quickly as anticipated. We're also seeing the effect in the U.S. equities markets. Now, the one thing that we did notice throughout the day was that the NASDAQ was absolutely experiencing a really dynamic move. It was trading up well over 1% on the day. Now, it is still trading higher, but well off of the highs. Highs have been paired, but still trading up about 0.4%. And when we go to our S&Ps, they are now in essence unchanged, and they were trading higher throughout the better part of the day. 1877, we're about 30 points off of the high. Low 38, we're about 10 points off of the low on the day. So traders, although it's only midweek and we're looking at a weekly chart, we can see that the Standard & Poor's equities markets have been under pretty substantial pressure. And one of the things that we have been looking at is this one area at around 1875. It's clearly seen on our daily charts, but even on our weekly charts, you can see where over this period of time, the short period of time, meaning the end of last year, beginning of this year, that was very much a supportive area. The same cannot be truly said at this point, as we see the market, which opened at that area about 1875, is now trading at about 1848. And in fact, even today, it was trading as high as 1877. Now, whether or not we take out these most recent lows, and I'm going to, as best I can, kind of draw a line here, we can see that it doesn't really match up perfectly with any real lows. You've got a low set of lows right in here that come in at about 1800, but that's much lower than the market is right now. We do have a series of lows right here, and that matches up to some degree with the current area that we are at. But typically, when we look at that, we're looking at some lows in here. As I said the other day, I really like to look at the bodies because it's the real bodies that give us so much more information. But traders, as much as I want to be bullish, I've got to question whether or not we could enter some sort of a bear market. Right now, we're only in a correction. Once we have, or I should say, if we have some sort of defined pivotal reversal, a V, so to speak, in which we have the market hit a genuine level of former support and bounce off of that, we would look for candlestick patterns. We'd also look at Henkinashi, the Japanese average charts, to guide us. But that is when I'm absolutely convinced that we would have a dynamic trade to the upside in the S&Ps. However, the fact of the matter is we haven't seen the recovery that we had been looking for. We are in the area that we would look for that recovery to be, but nothing has really materialized as of yet. And so it has to has to bring into question whether or not we could enter a bear market as opposed to our current status, which is we are just in a corrective period. Anytime you have the market trade off 10% from recent highs, that's a correction. Anytime it goes beyond 20%, that's considered a bear market. We're certainly not at that point where we're close with the NASDAQ, but that really recovered. So that's really why we've been reluctant to put any positions on in the Standard & Poor's. That market has a tremendous range, so the amount of dollars that will move back and forth on a intraday basis are pretty wide, and for that reason timing is critically important. I want to look back at the end of this year and know that periods where we kind of sat quietly and waited for a trade to materialize were well worth it because the subsequent trade was so profitable. And that's really my intention. Now, of course, one of the main issues that has been really stifling the equities markets besides the economic slowdown in China has been crude oil. Let's go ahead and take a look at that right now. So traders, even though we are not seeing the kind of moves that we have seen recently in crude oil, up 8%, down 6%, those tremendous price swings, we are down almost 2%, but the key is we're down. And crude oil is now trading back below, well below 28, and is, I believe, headed back to test the most recent lows that we have seen in the market, which came in roughly at about 26, and that's right in here. That came in middle of January. Now, really to get a sense or a feel for the market, we've got to really take a long-term view of the market. We really have to look back in time for a considerable period of time, this, of course, being 2002 back here. And we know that we have seen this market historically bounce off of that $25 price point. And that was the price point that I was looking for. We came close, as I said, when we saw the market hit 26. But the one thing about this, and it's just a technical basis, of course, but when the market traded to that particular price point and bounced up, it tended to find support right at about $25 throughout 2002 and throughout 2003. Of course, that's the last time historically oil was even at that price point, because following that, we did see oil make a stab and go as high as almost $90, about 88, come back down to about 38, and that's where 38, I believe, becomes our price ceiling on a technical basis, is this particular low here. Of course, we had this spike here in which we saw oil go from almost 150 a barrel down to these lows here, which are at around $35 a barrel. So we've got historical precedents here that's an important number. But right now, when we look at oil as it stands, it's much closer to this elusive $25 a barrel than anything else. And traders, that's where I think oil's headed. As long as oil does head lower, we could continue to see some pressure in U.S. equities. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow for another daily update and review. Bye-bye.